September 2024. A major institutional investor requests redemption from a $15 billion private credit fund. Standard 90-day notice period. The fund manager sends a letter explaining the request will be honored, but spread across 18 months rather than 90 days. Market disruption clause triggered. Redemption queue activated. The financial media barely noticed. Another liquidity management event. Nothing to see here. But here's what they missed. That $7 billion redemption queue wasn't isolated. 3 other major private credit funds implemented similar gates within 60 days. The correlation pattern was forming. The real threat isn't the stock market crashing with real-time price discovery. It's credit breaking in places that don't reprice daily. It's marks that lag reality by quarters. It's liquidity promises that can't be kept when everyone wants out. Private credit doesn't crash. It gates, then it marks down. Then it reveals that the yield you thought was safe was borrowed time. By the end of this video, you'll understand the 4-stage shadow credit breakdown model and why we're transitioning from stage 2, isolated stress, into stage 3, liquidity mismatch. You'll see how the 1.6 trillion private credit market created the same fragility that destroyed structured credit in 2008 and collapsed LTCM in 1998. You'll discover which 5 credit market signals reveal that redemption pressure is building system-wide, why private credit marks lag public market prices by 6 to 12 months, creating false security, and how the refinancing wall for leveraged borrowers makes stress inevitable. Most importantly, you'll understand why this hits jobs and wages first. When private credit stops flowing, business expansion stops, layoffs start, and the safe income. Products that middle-class retirement accounts depend on reprice after the economic damage is done. Shadow credit markets follow the same 4-stage breakdown cycle regardless of the specific instrument or decade. Stage 1, boom. Easy money creates reach for yield behavior. Private credit funds promise equity-like returns with bond-like stability. Covenants get stripped, underwriting standards decline. Optimistic assumptions about exit values become embedded in marks. The key characteristic? Everyone believes this time is different because leverage is in private vehicles rather than public banks, because daily pricing doesn't exist to create panic. The boom feels stable because valuation pain doesn't show up in real time. The false stability attracts more capital, more leverage, more reach. Stage 2, stress. Isolated blowups start appearing. One fund reports a problem deal. Media frames each event as idiosyncratic, bad management. Industry-specific issue, one-off occurrence. The narrative focuses on individual failures rather than systematic fragility. Here's what makes stage 2 dangerous. The denial period extends longer than in public markets. When stocks crash, everyone sees the price. When private credit stress emerges, marks adjust slowly, redemptions face gates, and correlation isn't visible until multiple funds hit trouble simultaneously. Borrowers that refinanced easily at 4% now face 9% rates, and discover lenders aren't available at any price. Companies start announcing hiring freezes and capital expenditure cuts. These are early warnings that stage 3 is approaching. Stage 3, liquidity. Mismatch. This is where the structural flaw reveals itself. Private credit funds offer periodic redemption rights, typically quarterly with 90-day notice. But underlying assets are illiquid loans with multi-year terms that can't be sold quickly without massive discounts. When redemptions exceed new subscriptions, funds face an impossible choice. Hold illiquid assets and gate redemptions, or sell assets at distressed prices, destroying NAV for remaining investors. Most choose gates, but gates create panic. Investors who couldn't redeem yesterday rush to submit redemption requests today. The queue grows. Meanwhile, private credit marks lag public markets by 6 to 12 months. Investors see modest declines in statements while similar public credits trade 20-30% lower. That gap creates false security followed by sudden recognition when marks finally adjust. This mechanism destroys middle-class wealth specifically. Retail investors in private credit funds see stable NAVs and think they're insulated from market stress. By the time marks adjust and gates lift, the economic damage, layoffs, reduced income, forced portfolio sales at losses has already occurred. Stage 4, credit contraction. Real economy impact becomes undeniable. Companies that depended on private credit for expansion capital, acquisition financing, or refinancing existing debt find funding unavailable. Layoffs accelerate. Capital expenditure gets slashed. Defaults rise. This isn't a market event anymore. It's an employment event. It's a wages event. It's middle-class income getting destroyed because the credit system that funded corporate expansion stopped functioning. Stock market investors might recover. Private credit investors often don't because the underlying assets default or restructure at severe losses. We're currently deep in stage 2 with clear signals of stage 3 approaching. The gates are already appearing. The marks are beginning to adjust. The redemption queues are forming. Most investors just haven't connected the pattern yet. This isn't speculation. This isn't politics. This is credit cycle mechanics repeating with identical outcomes. 3 times in recent decades, shadow credit markets created this exact boom-bust pattern with devastating consequences. 2007, 2008. Structured credit products promised high yield with low risk through diversification and financial engineering. Collateralized debt obligations, mortgage-backed securities. AAA ratings confirmed safety. Stage 1 boom, 2003, 2006. Yield-starving investors poured capital into structured products. Underwriting collapsed. Ninja loans, no income, no job, no assets, got packaged into securities and sold as investment grade. Everyone believed housing correlation was impossible, and geographic diversification eliminated systemic risk. Correlation was always high, but it only appears during stress. When housing prices stopped rising nationally, defaults accelerated everywhere simultaneously. The diversification that looked perfect in models meant nothing when the underlying assumption, perpetual home price appreciation, broke. Stage 2, stress, 2007. Bear Stearns hedge funds collapsed. BNP Paribas froze redemptions, citing inability to value assets. Media framed these as isolated. Subprime was contained. Core financial system was sound. Reality. Every structured product built on housing collateral faced the same stress. The marks just hadn't adjusted yet because these were illiquid securities without daily pricing. Stage 3, August 2007 through September 2008. Redemption pressure hit money markets, structured vehicles, and credit hedge funds simultaneously. Assets couldn't be sold without destroying value. Gates appeared. Mark-to-market accounting forced sudden repricing. The 20% theoretical losses became 50% actual losses when forced selling began. Stage 4, late 2008. Credit markets froze completely. Companies couldn't refinance existing debt, let alone access new capital. Unemployment spiked from 5% to 10%. Total private sector job losses. 8.7 million middle-class wealth destruction. $16 trillion in household net worth evaporated. It started with safe credit products that were leveraged bets on perpetual low rates and home price appreciation. September 1998. Long-term capital management nearly destroyed the global financial system through leverage plus liquidity mismatch. LTCM's strategy. Arbitrage small pricing discrepancies using massive leverage. $4.8 billion in capital controlled $129 billion in assets. The strategy worked perfectly until it didn't. Russia defaulted in August 1998. Flight to quality caused convergence trades to diverge. LTCM's models assumed positions could be unwound gradually. Reality, leverage, but plus illiquidity, plus margin, calls, certain power forced liquidation at any price. The Federal Reserve organized a $3.6 billion bailout because LTCM's failure would have triggered cascading margin calls across Wall Street. Leverage in shadow markets creates systemic fragility regardless of how sophisticated the strategy appears or how smart the managers are. March 2020. Credit market stress during COVID lockdowns nearly broke money market funds, corporate bond funds, and leveraged loan funds simultaneously. These weren't subprime mortgages or emerging market debt. These were investment-grade corporate bonds facing a temporary liquidity squeeze. But temporary didn't matter. Redemptions hit. Funds had to sell. Prices gapped lower. The Federal Reserve intervened with $2.3 trillion in emergency facilities to prevent complete credit market collapse. Without intervention, Stage 3 would have cascaded into Stage 4 within weeks. The lesson? Even safe credit markets experience gates and forced selling when liquidity evaporates. The structural flaw is baked into the design. Promise daily or quarterly liquidity on illiquid assets. And you create crisis when everyone wants liquidity simultaneously. 3 examples, 3 decades, identical mechanics. Boom in illiquid credit during low rates. Isolated stress dismissed. Liquidity mismatch when redemptions hit. Credit contraction, destroying jobs and wealth. The pattern is absolute. The signals are everywhere if you understand what credit stress looks like before it becomes headlines. Redemption pressure building systematically. Major institutional investors withdrew over $7 billion from large private credit funds in Q3, Q4 2024. That's not rebalancing, that's exit behavior. When sophisticated investors with early data access start redeeming, they're seeing stress retail investors won't see for quarters. At least 3 major funds implemented redemption gates or extended payout periods beyond standard terms in 2024. Gates don't happen because everything is fine. They happen because redemptions exceed the fund's ability to meet them without destroying value. Once one fund gates, investor psychology shifts. The question becomes, am I next? And redemption requests accelerate. Here's the mechanism most people miss. Private credit fund marks lag public market prices by 6 or 12 months on average. When distressed public bonds trade at 70 cents on the dollar, Similar private credits might still be marked at 92 to 95 cents. That 20-25 cent gap is future NAV destruction not yet recognized. Investors look at stable NAVs and think they're safe, but they're looking at stale marks. When quarterly revaluations finally adjust to reality, losses appear suddenly. This creates panic redemptions as investors who thought they were stable at 95 cents realize they're at 72 cents and falling. Covenant-Lite lending exploded during 2020-2023. Over 85% of new leveraged loans issued in 2021-2022 were Covenant-Lite. That means borrowers have minimal financial maintenance requirements. Lenders can't force restructuring until actual payment default occurs. That delay makes the eventual default more severe because problems compound before action becomes possible. When the credit cycle turns, Covenant-Lite transforms from flexibility into capital destruction. The early warning signals that would trigger restructuring in traditional lending don't exist. Companies continue deteriorating until catastrophic default rather than negotiated workout. Refinancing wall approaching for leveraged borrowers. The math doesn't work. A company generating $50 million EBITDA with $300 million debt at 5% paid $15 million in interest, 30% of cash flow. At 10% rates, that same debt costs $30 million, 60% of cash flow. The business model breaks, expansion stops, hiring freezes. Eventually defaults or distressed restructurings begin. Multiply that across thousands of mid-market companies funded by private credit, and you're looking at systematic stress, not isolated events. The companies will blame industry conditions or competition. But the underlying cause is simple. Credit costs doubled and refinancing access disappeared. Commercial real estate stress is spilling into private credit portfolios. Office building valuations declined 25-40% in major markets since 2022. Many of these properties were financed through private credit rather than traditional bank loans. As valuations fall, loan-to-value ratios spike, triggering markdowns and potential defaults. Private credit funds with CRE exposure, and most large funds have meaningful exposure, face portfolio write-downs, even if their non-CRE holdings perform well. That reduces NAV, triggers investor concern, generates redemption requests, and feeds the Stage 3 liquidity mismatch pattern. Bank loan officer surveys show systematic tightening, the tightest lending standards since 2009 for commercial and industrial loans. When banks tighten, borrowers turn to private credit. But private credit is simultaneously experiencing redemption pressure and margin compression. The alternative funding source is disappearing exactly when traditional banks pull back. This creates a credit availability gap. Companies that could easily refinance 2 years ago at attractive terms now face limited options at punitive rates or no options at all. That gap forces real economic decisions. Cut costs, delay expansion, reduce headcount, or face default. Corporate default rates rising from artificially low levels. U.S. high-yield default rates increased from 1.1% in early 2022 to 4.8% by late 2024. Distressed debt, bonds trading below 80 cents on the dollar, represents over $180 billion in the high-yield market. Each public default signals similar stress in private credit portfolios that haven't marked down yet. The pattern is consistent. Public markets reprice immediately, private markets reprice slowly, then all at once when gates and forced marks reveal reality. We're in the slowly phase, approaching the all-at-once recognition. When private credit breaks, the damage flows through multiple channels before it appears in headlines or financial statements. Employment hits first. Companies that depended on private credit for expansion capital, acquisition financing, or working capital facilities discover funding is no longer available at any price. Growth plans get abandoned. Hiring freezes immediately. Within quarters, those freezes become layoffs. A mid-market manufacturer with 500 employees and $200 million in debt needing refinancing faces simple math. If interest costs double from $10 million to $20 million annually, that's 100 employees worth of payroll that must be cut to maintain cash flow. Multiply that across thousands of leveraged companies, and you're looking at several 100,000 layoffs that aren't attributed to credit market stress. They're reported as strategic restructuring or efficiency initiatives. But the underlying driver is credit availability disappearing and refinancing costs doubling. Capital expenditure gets slashed systematically. Companies that planned facility expansions, equipment upgrades, or technology investments cancel those plans when credit costs spike and availability shrinks. That flows directly into construction jobs, equipment manufacturing, and service providers. The ripple effect extends far beyond the company making the credit-driven decision. Middle-class income destruction works through multiple paths simultaneously. Direct job losses at companies unable to refinance debt. Indirect job losses at suppliers and service providers when CapEx gets cut. Wage pressure at companies that remain employed but face higher costs and reduced pricing power. Retirement account losses when private credit funds finally mark down NAVs and reveal previously hidden losses. A middle-class family with $200,000 in a pension plan allocated 15% to alternative income strategies, often private credit funds, faces potential 20 to 30% losses in that allocation as marks adjust and defaults rise. But unlike stock market losses that occur with real-time visibility, these losses emerge suddenly after quarters of false stability. The psychological impact is worse because the betrayal feels deliberate. I was told this was stable income with low correlation to stocks. How did I lose 25% when the NAV showed only 3% decline last quarter? The answer: mark lag plus gate restrictions prevented earlier recognition and exit. Portfolio effects cascade through pension systems and insurance companies. State and corporate pension plans increased private credit allocations from 3% of assets in 2015 to 8 to 12% by 2023. That represents hundreds of billions in exposure. When private credit marks down 15-20% system-wide, pension funding ratios deteriorate, requiring increased contributions from taxpayers or employers, or benefit cuts for retirees. Insurance companies hold significant private credit exposure to generate yield for policyholder obligations. Markdowns in private credit portfolios reduce statutory surplus, potentially triggering regulatory action or requiring premium increases to restore capital adequacy. The cost gets passed to consumers through higher insurance premiums, even if they don't directly invest in private credit. Here's what makes this particularly dangerous. There's no policy fix when Stage 3 begins. The Federal Reserve can't buy private credit assets like it bought public bonds in 2020. Private funds have gates and restrictions that prevent central bank intervention from reaching trapped capital. The losses are locked in, the marks will adjust, and the economic damage, unemployment, wage cuts, benefit reductions, flows through before anyone acknowledges the scale. The wealth transfer is permanent. Companies that default restructure with equity holders wiped out and debt holders taking severe haircuts. Those losses don't recover when the economy improves. Unlike stock market crashes, where prices eventually recover, credit defaults create permanent capital destruction. 5 indicators tell you exactly where we are in the credit cycle and when Stage 3 transitions to Stage 4. Private credit fund gate announcements and redemption queue disclosures. When multiple large funds implement gates within a 6-month period, that's systematic stress, not idiosyncratic issues. Currently, we're at 3+ major funds with extended payout periods or gates. Watch for this reaching 8 to 10 funds, which would confirm Stage 3 is fully engaged. NAV volatility in private credit funds versus public credit market moves. When private credit NAVs decline 8 to 10% in a quarter, while showing 2 to 3% declines in prior quarters, that's deferred mark recognition catching up to reality. The sudden acceleration signals managers can no longer justify optimistic marks. Watch for quarterly NAV declines exceeding 5% on a sustained basis. High yield default rates and distressed debt volumes. Default rates above 6% historically signal credit cycle stress that impacts private markets with a 2-3 quarter lag. Distressed debt, bonds trading below 80 cents, exceeding $200 billion in the high yield market indicates systematic stress rather than isolated defaults. Current distressed debt at $180 billion suggests we're approaching that threshold. Leveraged loan refinancing success rates. When fewer than 60% of maturing loans successfully refinance at market terms without distressed restructuring, that signals the refinancing wall is hitting. Companies that can't refinance either default or accept punitive terms that make future default likely. Watch for refinancing success rates dropping below 65%, which would indicate capital availability crisis. Senior loan officers survey tightening indices. When the net percentage of banks tightening lending standards exceeds plus 40, meaning 40% more banks are tightening than loosening, that level historically precedes credit-driven recessions. The gap between banks tightening and companies needing credit widens. Alternative lenders like private credit should fill that gap, but can't if they're experiencing redemption pressure simultaneously. This isn't about timing a market bottom. This isn't about getting rich from crisis. This is about recognizing when credit market mechanics are breaking down before the employment and wage consequences hit your income and wealth directly. Next episode, the commercial real estate maturity wall. How $1.5 trillion in CRE debt maturing between 2024 and 2027 forces paper value into distressed selling. Why regional banks hold the exposure that could trigger cascading failures. How the valuation gap between buyer and seller bids creates transaction paralysis that prevents price discovery. And why this flows directly into private credit stress, bank loan losses, and real economy contraction that accelerates the credit cycle breakdown. The gates are appearing, the marks are adjusting, the credit availability gap is widening. Systems don't break suddenly, they break predictably, then all at once. Understanding what is happening while it's still in Stage 2 gives you time to position before Stage 4 employment and income consequences become undeniable.